There are a lot of investment and tax planning tools that are only available to people that are working, but there's one tool that's only available to people over the age of 70.5.
0.5 being the important part, I guess. Today, Mike and Patrick from Mako Financial Group fill us in on qualified charitable distributions, what they are, and when to use them. Good morning.
Good morning.
Good morning.
All right, well, let's start with that question.
I don't know why the IRS came up with 70 and a half, but yes, to understand what a qualified charitable distribution is, you first have to understand required minimum distributions. So if throughout your working career you were able to put money into a pre-tax investment like a 401k or an IRA, at some point Uncle Sam's going to make you start taking that money out. They're not going to let you get that tax deferral forever, and that age is 70 and a half. So you've been a diligent saver, and at some point you maybe have $1 million or whatever more, hopefully. The IRS says, great, you're this age, and now based on your life expectancy, you're going to need to take a certain percentage of your account out every year. So that's good, I guess, because you're getting the money back. But it also creates a tax issue, an income tax, because any distribution from an account like that is taxable as income. Well, for some people, if that account is bigger, the amount that the IRS is going to make them take out is higher, and that can present some tax issues at that point.
Well, can you do anything with it? I mean,
you can spend it.
Okay, something functional.
Yeah, and I think that's really where the qualified charitable distribution comes in, because at that age, you've already turned on your Social Security. If you have a pension, you've already turned it on. And so you already have all these other income sources, and so essentially you have what we affectionately refer to as a tax bomb with the required minimum distributions. Because they're required, you have to take them, right? Well, there's one, I guess, way to go around that, and that is the qualified charitable distributions. In replace of the required minimum distributions, you can instruct your advisor to send that money to a recognized charity, right? Your charity can't be your kids or something else. It has to be a recognized charity.
The Human Fund, you
yeah,
know,
exactly.
from Seinfeld.
Yeah. But in that case, the important thing is then that money never actually hits your tax return. Okay? It's never counted as income, and especially under the new tax law, then you know, otherwise you could take it out and have it counted as income and then give it and have it count as a deduction. But in this case, you're actually skipping that entire process. Now, that presumes that you have enough other sources of money that you don't need it, right? And it also presumes that you actually want to give it away to charity. So if you want to keep it all for yourself, that's okay. But this is one way, if you're inclined to give money to charity, to use this as a vehicle to be very efficient with your dollars and with your taxes.
Now, how does this, if you're sitting there going, how do I know if I have enough money? Because if you're 70.5, life expectancy could take you another 20 years.
Great segue,
Yes.
Elaine.
How do you know?
You know, this is obviously a thing that we work out with our clients. It's through the retirement planning process. And one of those things that I don't think people really understand, they think all that work happens in a person's late 50s or early 60s as they're making those decisions, but that's the tax management piece of that is really after that, and that's one of the things that we do.
Okay, well, you can find out all about this. If it sounds confusing to you, that will help you sort it out. And setting up an appointment with the team by heading to makofinancial.com.
Their offices are on Main Street in Green Bay. The number is 920-617-6830. Thank you.
Thanks, guys.
Thanks.